Welcome to part 2 of Brickflow's October Industry Insights. For those that haven't seen it before, it's a monthly roundup of the common trends and conversations we're having with commercial finance brokers, property entrepreneurs, property agents and lenders. The video is designed to give you the inside track of what is happening in the market at the moment and to put you in touch with the current market sentiment. After a tumultuous 7 weeks of government and economic upheaval, this month we assess the effects that this has had on the commercial property and finance markets. In part 1, we focused on development finance, and in part 2, we focused on bridging finance and commercial mortgages. Much like with development finance, in the bridging sector you have similar funding structures, banks and non-banks. Those that are funded by banks have seen rates go up. Those that haven't and have alternative and more diverse funding structures have been less affected. So again, it's super important to shop around to ensure you get best value. Two lenders that used to price very similarly can now be several percentage points apart, depending on their funding structure. So speak to a good broker that understands the market to make sure you get best value. The bridging sector will almost certainly be the busiest commercial property sector next year and will have a big part to play in any property price corrections that we see in 2023. Firstly, borrowers with bridging loans on land where the plan was to sell their land post-planning or where they're even going to develop the site themselves will now be seeing the value of those assets fall. Since they purchased that land, build costs have risen and property prices are now stalling. A site that might have had a residual land value of 1 million 12 months ago might now be worth 800,000 or lower. If I'm a bridging lender that lent 70% of the value 12 months ago, 700,000, I'm now very worried. I will be in regular contact with that borrower trying to understand their plan for me to be repaid. Can they introduce more equity? If they can, I want to see a capital reduction now and I want a very credible plan and timeline as to how I can be repaid. If the borrower can't introduce more equity, then me as the bridging lender needs to get this asset to market quickly before prices fall further. This would be an example of a false seller. Whilst the above is an example of the bridging lender being a catalyst for a price correction, it will also be the safety net. And what I mean by that is that in a distressed market, the only way to buy these assets is with bridging finance or cash. With distressed assets, there will be a short window where lenders give the owners the opportunity to control their own destiny by allowing them to sell on their own terms. Buyers will need to transact in a couple of weeks or days, however. Then the lender will take matters into their own hands and the property is likely to end up in an auction where again the buyers are using cash or bridge money to purchase. The availability of credit throughout the market will mean prices can only fall so far. In 2008, prices dropped like a stone because the only buyers were cash buyers, there was no credit. But this time around, the number of buyers is multiplied massively by the availability of bridge loans. Whilst the correction is due with land, I think those expecting huge discounts will be disappointed. Finally, this month, we look at the commercial mortgage market. Of the three commercial property finance markets, that's commercial mortgages, development finance and bridging finance, commercial mortgages will be almost certainly the most affected by the recent volatility. And when we talk about commercial mortgages, we talk about loans against hotels, offices, retail, warehouses, but also loans against residential portfolios and blocks. Again, in this sector, you have a spread of bank and non-bank lenders. And again, you have lenders, mainly banks, whose pricing has been materially affected by the recent volatility. Non-banks, on the other hand, have been affected to differing degrees, but how much their pricing has gone up will all depend on their underlying capital sources. However, the big difference in this sector is that unlike with bridging finance and development finance, the interest on commercial mortgages needs to be serviced by the income of that asset. Interest on bridging and development loans is rolled up into the loan and paid at exit, so the higher rate isn't as much of a problem. Yes, if interest rates are higher, the equity cushion is eroded quicker, therefore the lender will want to lend less money at the outset. But the effect of rising rates is much more pronounced with income producing assets, where income ratio covers are the main driver. As an example, prior to the recent market turmoil, a £20 million commercial property with income of £1 million per year might have supported 12 million in debt. Now with rates of 6 or 7%, then that's more likely to support 7 or 8 million. We know that the artificial spike in pricing was due to the mini budget. Now, the inflationary policies introduced by that mini budget have been reduced. So markets are settling down. However, whilst interest rate predictions are now lower, we still have the actual interest rate rises to come, which is something that is happening. Lender spreads are likely to narrow and to offset some of the increase of the base rate, but the underlying cost will increase by a bigger margin. So for a while at least, buyers of commercial properties will have to come up with significantly higher deposits, or sellers will need to accept lower prices. Of course, much like the residential sector, if you don't need to sell, then you won't. The new debt positions point towards a huge fall in prices, but the reality is that if the interest rate spike is short term, very few owners will be affected. Instead, trading volumes will fall and the lack of stock will support existing prices. If you fast forward 12 months and if rates are forecast to fall, then debt serviceability improves and debt quantums return. Buyers and sellers are back to where they were after a 12-month stalemate. Much like in the residential mortgage sector, if you have a commercial mortgage that matures in the next 12 months, then you are a very unfortunate victim of timing. Refinancing will be hard, and depending on your rental cover and leverage, you may need to make a capital reduction. If you can't, then you may be forced to market. This will of course depend on the underlying lender. Engage them early and come up with a plan, and they should be more sympathetic. Whatever happens, it will be a very interesting time over the next 12 to 18 months and see how it plays out. We will of course keep providing regular updates to what we're seeing and hearing through our conversations with the market. I hope that was useful, and bye for now.